By the end of 2026, the world's largest tech companies are projected to spend a staggering $765 billion on capital expenditures to build out artificial intelligence infrastructure. That massive wave of corporate spending is the primary engine keeping current tech valuations elevated, pushing indices like the Nasdaq to historic highs. But that microeconomic boom is currently colliding with a severe macroeconomic headwind. This chart shows the contradiction perfectly. On the left, we have soaring AI investment. On the right, government borrowing costs are spiking, hitting 5.27%. Expanding the timeline reveals just how high that is. We haven't seen yields demand this much since 2007. Investors are caught in a trap. On one side, there is a massive technological build-out. On the other, the bond market is demanding a massive premium for cash. You can't just blindly ride the tech wave anymore. Navigating this environment means calculating how borrowing costs will actually impact those massive corporate spending bills. The catalyst for this recent bond market shock sits at the Federal Reserve. Under Chair Kevin Warsh, the central bank has changed its approach. Warsh has intentionally ended the era of forward guidance, the practice of heavily telegraphing interest rate moves before they happen. Without that safety net, the market is forced to price risk entirely on its own, which has led to violent, unpredictable swings in rates. The math here is unforgiving. Higher borrowing costs mechanically compress the valuations of growth-heavy stocks, and the massive AI infrastructure build-out compounds that risk. These companies are burning billions in cash today for profits that won't materialize for years. This is the dilemma for anyone looking at the Nasdaq right now. You want to capture undeniable tech sector growth, but you can't leave your portfolio entirely exposed to sudden interest rate spikes. Traditional buy and hold strategies are perilous in this environment. You must scrutinize the specific architecture of the ETF you use to hold the Nasdaq, rather than deciding whether to hold it at all. Let's look at the default approach, market cap-weighted ETFs like QQQ or 1EQ. There is also a new wave of budget clones like QQQM and QNDX that offer the exact same index exposure but drastically cut management fees down to 10 or 15 basis points. This matrix illustrates why these are popular. They provide direct, undiluted exposure to the Magnificent Seven tech giants, projected to see an 85.5% earnings surge. But look at the structural vulnerability. Up to 48% of the entire fund's weight is concentrated in just 7 companies. That extreme concentration turns these ETFs into a lightning rod. When the Fed signals a rate hike, these 7 debt-sensitive giants take the blunt force impact. And if those specific companies experience any delay in monetizing their massive AI investments, the entire fund will drop with them. Core ETFs maximize your potential upside, but that heavy concentration makes them highly dangerous if you are sensitive to macroeconomic volatility. If you want to limit that vulnerability, the first alternative is a structural diversifier, like QQQE or QQQJ. These funds actively strip away big tech's dominance. By using an equal weight approach, as shown in the second row, you limit portfolio damage if massive tech giants face cash burn issues. The trade-off is unavoidable. You will see severe underperformance if big tech monopolizes the AI rollout and crushes smaller competitors. For the most defensive posture, we look at income and hedged plays, like QQQH and IQQQ. These funds utilize derivatives. By writing covered calls against the underlying tech stocks, they generate substantial, regular cash flow. As seen in row 3, they generate massive yields, up to 8.22%. That cash acts as a shock absorber against rate volatility. But the math of a covered call strategy structurally forces you to forfeit explosive gains if a massive tech bull run happens. These complex strategies also come with high expense ratios, often around 68 basis points, which will eat into your long-term compounding. Diversifiers and hedged funds effectively buy you protection and yield, but they mathematically guarantee you will sacrifice maximum returns if the AI narrative plays out perfectly. The reality for late 2026 is there's no perfect risk-free way to play the Nasdaq while the Fed maintains an unpredictable, high-yield environment. To make a decision, we need a framework based on your primary market fear. The most important question is, what are you worried about? If your biggest fear is missing the AI boom, follow this path to core and budget ETFs. Stick to the heavyweights, but optimize your hold by swapping expensive funds for low-fee clones like QNDX. If you fear putting half your money into just 7 companies, take the concentration risk path toward diversifiers. Equal weight funds let you capture broader tech adoption without relying solely on the giants. Finally, if you want tech exposure but are tempted by safe treasury yields, your concern is Fed volatility, which leads to income and hedged ETFs. These hedged funds act as the perfect bridge, offering you tech-adjacent yields while absorbing the shockwaves of central bank uncertainty. Notice that every single path requires an active, conscious compromise. There are no free lunches in this macroeconomic environment. With the Federal Reserve refusing to provide forward guidance, explicitly defining your own risk tolerance is the only reliable compass for your portfolio.